Good afternoon, everyone. It's good to be here with you for this workshop. Before we jump into it, I do want to highlight a few COVID-19 related resources that you might avail yourself of. There's a good number of resources online having to deal with CDC and OSHA guidance on how to maintain a COVID-safe workplace. So if you haven't already checked some of these out, I'd recommend looking through them for the latest guidance, which has been known to change. Now, today, we are going to be going over how to buy and sell a business, some of the important considerations there. Now, the first part of this presentation is going to be broken down into four parts. There's the preliminary considerations that you should know about when you're deciding, whether to buy or sell a business, when you're in that preliminary stage, some things that you need to keep in mind. We're going to go over the steps to buying or selling a business, some of the key documents you're going to need, because there's more than just a purchase agreement. There's a lot more than just a purchase agreement. And then lastly, we're going to go over some common misconceptions and helpful tips to help get you through the process. To start here, I want to emphasize that, I'm a lawyer. I deal with simple and complicated transactions all day, every day. I mean, mergers and acquisitions, it's the bulk of my legal practice. And I'm here to tell you, they don't have to be all that complicated. You don't need, you don't need to spend $20,000, $30,000 in legal fees just matching up a buyer and a seller and handing off a business. Most business transactions don't look like that. And everyone is different, but I've settle up most of these business sales for at most a few $1,000s. It's only the real edge cases that can get into high figures. They don't have to be complicated or expensive, but it's important to do them right, because if you don't do them right, you're left in a position where you're not sure what your rights are, what you can really enforce against the other parties. Good transactions are just like contracts. They need to offer certainty as to what each party's obligations are and ways to enforce those obligations. Those that if there's any takeaway here, is that you want to make sure that your purchase and sale is done in such a way that you cover all your bases, you get what you need out of the transaction, and the other party gets what they need. Everyone walks away knowing what they're supposed to do and knowing what happens if they don't do it. So, it's a good idea to involve a lawyer in the process of buying and selling a business to represent your interests and make sure that the transaction happens the way everyone wants and expects it to. But it's also really important, and I speak from a lot of experience here. If you're going to involve a lawyer, you want to involve a lawyer whose practice actually involves business transactions. And I say that because there are some lawyers who will take any case, not knocking them, but if the lawyer's primary focus is litigation, lawsuits and disputes and conflicts, they don't always approach a business transaction in a constructive or collaborative way. I'll talk about this more later, but buying and selling a business is not a zero-sum game. It's not a situation where one party wins and the other party loses. If you do it right, both parties win. I mean, both parties get what they want out of the transaction, which is ostensibly money for the seller and a business for the buyer. So keeping that in mind, let's go over some of the preliminary considerations that you should be going through. The first, and you might not think this is the first, but this is definitely the first. What are you looking to buy or sell? There's two different kinds of a business sale. There's what's called an asset sale and a stock sale. Stock being kind of a catch-all term for, shares of stock of a corporation, membership units of an LLC, partnership rights of a partnership, things like that. I mean, stock versus asset. And I always frame it this way for people. If you think of a company as a big box that contains all of the assets that the company needs to do business, it's got the equipment, the furniture, the real estate, if it has any, the inventory, the intangible assets, the trade names, copyright, trademarks, whatever. And then the goodwill, which is the kind of the established value of the company in the community, just its kind of nebulous value as a going concern. A company contains all of that. It's just a giant container with those assets. And when you're buying or selling a company, you can either buy all of the assets from within that box. You just empty out the box and then put all those assets in a new box, which is an asset purchase. Like if I'm going to, buy from Target LLC and then make, new Target LLC and then just buy the assets from Target LLC and put them into new Target, that's an asset purchase. Because what I'm left with is a brand new LLC, but all of the assets of the old LLC. The old LLC still exists and it's just going to go off and shut down at some point, presumably. That's an asset purchase. But you can also just buy the box, which is by far the simplest, but also comes with its own ramifications. That's a stock sale. And no one who isn't a lawyer really thinks in these terms when you're deciding whether to buy or sell a business. But this is so important for the reasons I'm about to outline, that it's a preliminary consideration that you need to decide before you move on to contracts, for example. Before you even move on to the LOI, you should have this in mind. Now, there's a few key differences here. And historically, stock sales typically benefit the seller of a company, because when you sell the stock of your company or membership units or whatever, it's typically treated as the sale of a capital asset. Your stock is a capital asset, which if you hold it for more than a year, means you get long-term capital gains treatment on the sale of your stock, which ordinary income rates at the federal level for taxes, it's up to 35%. Capital gains is 20% for long-term capital gains. So the benefit there is obvious. You can save almost half in taxes, or more if you're dealing with a C corporation, qualified small business stock, which we won't get into here. But just know stock sales, the tax benefits to the seller are pretty obvious most of the time. For the buyer, when you buy the stock, again, you're buying the container with all of its assets inside. If the container, the company already depreciated its assets and you buy the company, you can't redepreciate those assets. You're buying it with its assets in its already depreciated state. So you can't take those depreciation deductions from your taxes going forward. The assets have already been depreciated. And when you buy the stock of a company, you're buying its assets and its liabilities, known and unknown. So if the company has a lawsuit in waiting, you're buying that lawsuit in waiting. You can structure your purchase agreements to provide that the seller indemnifies you for it, meaning the seller will have to come out and pay any judgments if one of those claims comes to fruition. But ultimately, the buck stops with the company and its liabilities carry forward with it to the buyer when you're doing a stock sale. Compare that to an asset sale, which is just the inversion in some ways. Typically better for the buyer, because when you buy assets of a company in an asset sale as the buyer, you get to allocate the total purchase price among those different assets based on their fair market value. You can't over allocate, but you figure out what the fair market value of those assets is, and that's how much purchase price you apply to each of those assets. And then as the buyer, you can turn around and redepreciate those assets over a period of years, typically between 1 and 15 years, depending on the type of asset. So you get huge tax benefits as the buyer in an asset purchase. You can also exclude most of the liabilities of the company you're buying in an asset purchase, because you're just buying specific assets and maybe taking on specific liabilities. For example, a lot of times when you're buying a company in an asset sale, you'll negotiate to take on the lease of the company. You'll negotiate to take on any contracts with vendors and with customers or clients, which is, you consider that an asset and a liability in a sense, because you have to perform under them. But, you pick and choose in an asset purchase with a few limitations that we'll cover at the end. There's always limitations. It's the law. The sellers, when you sell your assets out of your company, you have a mix of capital gains and ordinary income. And the reason for that is, if you depreciated assets, like let's say you have an asset with a fair market value of $10,000 and you as the seller already depreciated 9,000 off of it. So, you've got $1,000 left of tax basis, and then you turn around and you sell that asset in an asset sale, and it's valued still at $10,000. you're going to pay $9,000 in ordinary depreciation recapture income. You're going to pay tax on that $9,000 at your ordinary rates to make up for the depreciation that you already took on it. The idea is it's basically reversing depreciation. So when you're the seller selling assets that have been depreciated, you're going to have some ordinary income probably, as well as capital gains for most other things. It can really be a mixed bag, and you typically want an accountant there to figure out what your tax hit will be as the seller. But just know that the tax hit for the seller is worse in an asset sale than in a stock sale for the most part. That said, sometimes the buyer wants a stock sale despite the clear benefits of an asset sale. If you're buying a company which bases its value in its contracts, like if it has a bunch of customer contracts that are very valuable, but they can't be assigned in an asset sale to the new target company or whatever, you have to buy the stock of the existing company if you want to keep those contracts. By and large, there might be some change of ownership provisions as well, which is outside the scope of this workshop, but by and large, stock sale will preserve the contracts better than the asset sale. Similarly, you can keep the EIN in most stock sales, so that's of value to the company. Sometimes the seller might want an asset sale despite a stock sale. For example, the benefits of a stock sale. If, for example, you've got a company that only wants to sell one of its locations. If it's a restaurant with 3 locations in Albuquerque and they want to sell one location, they would do that through an asset sale for those specific assets. These aren't hard and fast rules here. Everyone's situation is different, and it's worth talking to someone to customize the approach for your needs and priorities. The next basic consideration is the purchase price. This is a given, but I can't tell you how many of my clients have come to me wanting to sell their business. They've got a buyer, but they don't have a purchase price. And you need to figure out, purchase price holistically, what that looks like. It's not just cash, it's cash, property, shares in the buying company sometimes, and then the purchase price can vary from the fair market value of what's being purchased based on, the long-term business prospects. Is it a good, profitable business that they're going to pay a premium on? Is this a high-risk purchase that they're, going to demand a discount for? That's very common. Sometimes the buyer insists on a discount to buffer against potential risks. So you got to negotiate the purchase price and figure that out. The next basic consideration is timing, which is, when do you want this to happen? Is it going to happen now? Is it going to happen in a few months or weeks, or is it going to happen at the start of the next year? You can really customize this to whatever it is you want. Typically, it's as soon as possible. And, when you're going the ASAP route, it's so important to be practical of what that really looks like. I have clients all the time who say, I want to hire you to close next week. And can I do it? Sure. Are you cutting a lot of corners and skipping a lot of steps that you might regret later? Absolutely. And one example is due diligence, which we'll talk about a little bit later. But due diligence alone takes 30 to 45 days at a minimum just to get the records that you need, the financials, the books, the tax filings of the company, the profits and loss statements, then to have your accountant look them over to make sure there's nothing suspect about them, to assess the company's overall financial health and long-term viability, to do a market analysis. If you really want to do a market analysis as the buyer, to figure out, okay, what's the potential for growth in this market in the next few years? Due diligence is a process that a lot of people neglect, but you really shouldn't. So when considering the timing, it's best to be practical. And part of being practical is doing what you need to do as early as possible. If you're in the process of selling your company or buying a company, don't wait until a week before closing to get a lawyer involved. Go find one that works for you and start collaborating sooner rather than later. Go get a CPA or accountant to help you with the due diligence. It's very important to be proactive in buying or selling a business. So just keep that in mind as far as timing goes, because ASAP means different things. And lastly, as far as basic considerations go, there's post-closing obligations. And what that means is, What are the parties' obligations post-closing? Once the business has formally changed hands, is the seller, principal, the owners of the selling company, are they going to stick around to provide transition services? Are they going to train the buyers, managers, and employees to do the job so that the company can keep running successfully? What about accounts receivable, money that the company has billed prior to the sale, but that's going to be collected after the sale? Who's going to collect it? Who's entitled to it? How does that factor into the purchase price? Accounts receivable is a sticking point in almost every transaction I've done, just because no one considers it before they get to some of the later stages of the transaction. The buyer assumes that they're buying the accounts receivable and they're entitled to all that money. The seller says, no, I expended the labor and material costs to do that work and then billed for it. I should be entitled to the accounts receivable. I've seen some transactions fail over this at a late stage because it was never considered, and it was, the accounts receivable, if we're talking $100,000, $200,000, it's material. So these are things to consider in the early negotiating stages. 7 steps I've identified here. The exact number varies based on who's giving this presentation, but I can break them down into 7 pretty easily. There's the discussion and preliminary agreement stage, usually with a non-disclosure agreement. There's the letter of intent stage, where you put the initial loose agreement of the parties down in writing, usually in a non-binding form. There's due diligence, which can kick off after the letter of intent or after the purchase agreement is signed. I usually recommend starting it earlier rather than later. Then there's the negotiation and signing of the purchase agreement and related documents. Then you continue due diligence for a while before closing, and then at some point you close the sale, which is where money changes hands, the company changes ownership, and that is the marking point where you have before closing and after closing. And then after closing, it's just the post-closing transition period where things are handed off, accounts are handed off and changed. There might be some obligations of the seller, like I said, to train employees of the buyer. There's that post-closing transition period, which can be null. I mean, I've seen some cases where there just is no post-closing transition period. I've seen some cases where it's lasted years. And as a general rule, if you are seller financing this deal, which is to say the seller is putting up the capital, the buyer is agreeing to pay the seller over time for the purchase price of the business. When you have seller financing, that's when you have longer post-closing transitions, because the seller stays in the mix for longer until the note's paid off. And we'll go over that a little bit more. The first stage, it's the discussion and preliminary agreement stage. If you are a would-be buyer, you typically reach out to the seller of the business or would-be seller. You figure out, is the seller even looking to sell? If so, what are their priorities? What are they looking for in terms of this deal? Is this going to be something that we might be able to come to a meeting of the minds on? If yes, then you usually sign a non-disclosure agreement. And that's so that the buyer can look at the seller's financials before making an offer, because you want to know, what is this company bringing in? What's its gross revenue stream? What's its profitability, its margins? What's its real value? Because as a seller, you can't just make a blind offer for a purchase price without knowing what the target company is worth, what it actually brings in. So that's typically done under a non-disclosure agreement so that the would-be buyer can't disclose what they learn in this process, and they can't use it competitively. These NDAs typically carry through due diligence, and either for a period up until the sale, if the sale goes through, or if the sale fails, lasts for a period of maybe a year or so. The financials are outdated in a year. The competitive position of the target company may have changed in a year. The buyer's priorities may have changed in a year. So usually these NDAs last for about a year after they expire, after either the sale happens or the sale fails. You usually involve a CPA or accountant to review the financials you get in this process. And in due diligence, like I said, most business owners and buyers don't have accounting training. So they're not going to be able to make full sense of the P&Ls, the tax returns, and financial statements. So it's good to build your team early and to have an accountant or CPA on hand to help you with this process. Now, assuming you get through this process and you like what you see and you're ready to make an offer, you hash it out with the buyer and the seller. They hash something out. They come to an agreement on the material terms that I outlined earlier. The material considerations: stock sale versus asset sale. What's the purchase price? What's being purchased? How's it going to be paid? There's a number of options there to pay the purchase price. There's cash, which obviously every seller's dream is to get paid in cash. There's financing, whether SBA financing or private lender financing. There's seller financing, which we talked about, which is the seller agreeing to be paid over time by the buyer. They take a promissory note, they get paid over time. And there's some combination of all of the above. But you figure these things out, and then you memorialize them in what's called a letter of intent. Letter of intent, it's usually non-binding, doesn't commit the parties to actually go through with the sale, but it shows the seriousness of the parties and a meeting of the minds that's necessary before you leap into more thorough due diligence and before you start spending the real money on attorneys to have them draft and negotiate the purchase agreements, which I'll cover in the next section, what documents go into it. But the bulk of the expenses happen after the letter of intent phase. You still want attorneys, if possible, to draft the letter of intent. Prepping a letter of intent for me takes an hour or two in most cases. It's the rest of the documents that are really, they take the time, and that's where the expense is. So the LOI is meant to ensure that the parties are in agreement and serious about going through with this before you move on. Because after you get the letter of intent, in most cases, that's when you start due diligence. And that's where you start really requesting records. I mean, before the letter of intent, once you sign an NDA, you can ask for P&L statements and things like that. And the would-be seller will work with you to a point, but they're not going to open up all of their books and records and tax returns to someone when they don't have an agreement in principle to sell the business. So due diligence kicks off in earnest here, and that's when you start really scrutinizing the company to make sure that everything's above board, it's profitable, it is what you expect it to be. Sometimes you can interview managers and employees, though sometimes you can't. Often the seller will not tell their employees and managers they're selling the company until they've sold the company. And that is between the buyer and the seller as to whether or not the buyer is going to be able to interview these people. But it happens in due diligence. While due diligence is ongoing, you typically negotiate the purchase agreement and sign the purchase agreement. The purchase agreement, it's the stock purchase agreement for stock sale, the asset purchase agreement for an asset sale, plus the other related documents that we'll cover. It supersedes the letter of intent. The purchase agreement is binding. And as I point out here, this is really your last chance to get a lawyer involved in a way that's going to protect your interests, because anything that, once you sign the purchase agreement that's binding, it's very difficult or impossible to fix later if both parties aren't in agreement. And so you could be signing away your rights or failing to secure your rights in the way that you want to if you don't have someone who's actually trained in preparing legal documents to do this for you. So this is kind of your last off ramp, if that makes sense. Now, the purchase agreement, it can do one of two things. It can either continue or start the due diligence period, in which case you set the closing date for some period some date after you sign the purchase agreement. That way you still have time to do due diligence. And if the due diligence goes awry and you learn something after signing the purchase agreement, you want to make sure that there's termination provisions that say, nope, we've changed our mind, there's something wrong with this company, we're going to walk away. The purchase agreement would need to specifically allow for that, because the purchase agreement is a binding agreement to purchase the company. You can continue due diligence if the purchase agreement provides for it. Alternatively, some people close at the signing of the purchase agreement, in which case, your due diligence, you'd have had to do it during your LOI phase before you sign the purchase agreement. Everyone's situation is a little different. I'm personally a big fan of having as much due diligence as is practicable so that everyone can be comfortable with what they're buying. Oftentimes, the due diligence period will continue after the purchase agreement is signed, but before closing. Now, closing is when the sale transaction is actually consummated. It's where the bills of sale are issued, the promissory notes issued, the purchase price is paid, or at least the amount of the purchase price that's paid at closing is paid. It's where things formally change hands. Closing can be a bit of a moving target depending on things outside the party's control. For example, if you're doing an asset purchase and you need to you need to make a new company to buy the assets from the target company, that can be held up by the Secretary of State. And I'll give you a practical example. I had a $3 million acquisition get held up for a month and a half because the Secretary of State had two employees working for them, and they were being astoundingly fussy about the form of documents, and they just would not budge. So they delayed a $3 million closing for a month and a half. We almost lost the deal. So there are factors outside your control that can move closing. And so it's useful in the purchase agreement to account for them by setting a target closing date and being a little flexible in there. Other things that could hold up a closing, assignments of leases or other contracts. If the buyer needs to assume the space occupied by the seller and the landlord is dragging their feet, that can delay closing. I've seen that happen many times. That's closing in a nutshell. That is the line that you draw where the ownership changes hands. And then, of course, there is the post-closing transition period where, payments continue to be made if seller financed. The seller provides transition services if agreed upon. Property would need to be retitled or deeded. I put this in post-closing. Ideally, this happens at closing, but a lot of the time, closing needs to happen for other business reasons. And then, the parties are agreeing to retitle or redeed certain property being sold, real estate, vehicles, things like that, which happens in the period of days or weeks after closing. It's just important to understand in the purchase agreement when these things are going to happen and how they're going to happen. But that's post-closing in a nutshell. So the documents that you need, and this is a non-exhaustive list. Once you have the letter of intent, the letter of intent is great. That gets you to the point where you're negotiating these documents, but these are the documents that you need in order to buy or sell your company. And it seems like a lot. It can be a lot, but this is how you do it properly, which is why attorneys, it's why you get attorneys involved in these sorts of things. The baseline document you need is the purchase agreement, the stock purchase agreement or asset purchase agreement, depending on the kind of transaction that you're going through. That just spells out the material terms of what's being handed off, what's being paid, how it's being paid, how the handoff works, what liabilities are being assumed, what liabilities are not being assumed, representations and warranties of the parties as to the viability and health of what's being transferred. This is key. And I swear, if I've ever seen people try and one up one another, it's in these representations and warranties. They supersede everything in the letter of intent, everything that you discussed over the phone or via email, everything in due diligence. It doesn't matter if you disclosed in due diligence that you haven't paid taxes for the last 5 years. If the stock purchase or asset purchase agreement in the representations and warranties, if it says that you have kept current with your taxes, that is a contractual promise by you as the seller. So it's very important to make sure that this purchase agreement lines up with your expectations and understanding of the situation, and that there's nothing untrue in the representations and warranties. Because if there is an untruth in there, the buyer can turn around and say, this lessens the value of what we bought. We are going to either hold back something from the purchase price if they're paying you over time via seller financing, or they might just say, we are going to sue you to recover the difference. And then you are in a protracted court battle. So, stock purchase or asset purchase agreement, this is the heart of all of these documents, and it's important to get that right. The bill of sale, that is the document that legally affects a transfer of property, most property. You use a bill of sale for tangible and intangible property, vehicles, equipment, machinery, furniture, etc. To some degree, it wraps in real property, real estate, though you want to make sure that that's done through a deed process. Same with vehicles and anything else that's subject to a deed or title. You want to make sure that that is legally done as well, so that the transfer of assets happens in total. But bill of sale, if you're going to be offering seller financing, you need a promissory note. That is a note issued by the buyer, which will it's just the document by which they agree to pay an amount over time. They specify the amount, they specify the duration of the note, when the payments are going to be made, what the interest rate is, and whatnot. There might also be a personal guarantee attached to the note if, for example, the purchase is being made, if the buyer is a company or corporation or whatnot, the company itself is liable for the debts, for the debt under the note, but the principals, the owners, typically are not personally liable. It's the whole point of an LLC or corporation. It's the owners aren't liable for the debts and liabilities of the company. So the way around that is to get what's called a personal guarantee as part of the note. The personal guarantee is where the owners, the principals or owners of the buying entity, agree to personally be liable for the debt in the case the company fails. So that's something that you might have as part of the note process. There's also the security agreement, which you would have if you're offering seller financing and the note is being secured by specific collateral. Frequently, this is the assets of the company, either the assets being purchased or all of the assets of the buying company. You'd have a security agreement for that. You might also have a security agreement if the note is being personally guaranteed for the personal assets of the guarantors. For example, a security agreement which would allow for an interest in all of the guarantors' personal property. It's very rare that you get to that level of security where you've got a personal guarantee and a security interest in the assets of the guarantor. But if this is a high risk situation for the seller might sometimes insist on something like that. So you've got a security agreement that spells out what the security interests are of the seller. A UCC one, financial or financing statements. These are things that you record with the UCC division of the state that can perfect a security interest in certain assets that are being used as collateral. It puts other would-be creditors on notice that you have an interest in these assets. So that's something that you might do as well if there's a security interest. Mortgages, the way to perfect a security interest on real property is to get a mortgage on it and to record that mortgage with the clerk of the county in which the property resides. So you might get mortgages as well if you're securing your interest as the seller against real property, either of the buying company or of the personal guarantor. I have seen personal guarantors put their own house up as collateral, and in that case, you need a mortgage against that house. Non-competition and non-solicitation agreements. These are if you want the seller's principals to agree not to compete with the company that is being purchased. They're very common because you typically don't want the seller to open up a competing business right next door after selling the company to you. It's bad public policy, and it is one of the few types of non-competes that courts will frequently enforce in this state. Courts very much dislike enforcing non-competes against employees, but they are fine for the most part enforcing them against sellers of businesses. So you might have a non-compete here. A post-closing services agreement, also known as a transition services agreement. This is where the seller principal agrees to stay on and train the employees or the buyer for some period of time, or to provide services or whatever. You'd want that agreement in place. Corporate resolutions authorizing the transactions and appointing new directors or officers. This is important because you may be the owner of a company, you may be the only owner of a company that's engaged in the buy or sell process here, but it's still the company that makes the decision to engage in that process for the most part, unless you're the seller doing a stock sale. And so the company needs to internally authorize these transactions by in the manner spelled out in their operating agreement or bylaws or whatever. So you need to make sure that you're dotting your I's and crossing your T's here by having corporate resolutions for your corporation or LLC or partnership, as the case may be. You also want to make sure that you're appointing new officers or directors after the sale happens if you're the buyer, because you don't want the seller to continue to be regarded as the director, president, whatever. Lastly, you need an operating agreement for LLCs or bylaws and a shareholders agreement for corporations if you're the buyer, because you want to make sure that going forward, you've got the documents in place that govern the company that you want rather than whatever the seller used. And that's very much a post-closing consideration, but I usually do it at the time of closing. That way, there's no gap period where the buyer is operating under the document the seller had. Now, the first misconception is that the buyer can avoid all liabilities in an asset sale. This is what I was talking about earlier in the presentation, where I said, an asset sale by and large lets the buyer avoid the liabilities of the seller, but certainly not always. New Mexico and most other states have legal principles of what's called successor liability or successor in business liability that attaches to the assets of a company being sold in an asset sale. If you sell the stock, the liabilities just transfer with the stock. There's no issue or question there. But in an asset sale, there are certain liabilities that will follow the assets. The biggest example I will cite here for New Mexico is gross receipts taxes. If the selling company owes gross receipts taxes, the tax debt of a company, the gross receipts tax debt of a company typically stays with the company and doesn't follow through to the owners. Even though the owners of a company don't become personally liable for the tax debt of the company, for the gross receipts tax debt of the company, the buyers of the assets of a company with a gross receipts tax debt take that debt with the assets. That's part of the law here. So you as the buyer obviously need to do a few things. You need to make sure that the gross receipts taxes of the selling company have been paid. There's provisions of the law that provide for you to do that provide for you to hold back a part of the purchase price that would be paid to the state in the event that there is a tax debt. It allows you to request what's called a tax clearance certificate, in which the state looks into the selling company and says, we can certify that it doesn't owe any gross receipts taxes. You can request that. And you also want to make sure that you have very good indemnification agreements in the purchase agreement, such that the seller is going to have to indemnify and hold the buyer harmless if there's undisclosed liabilities, including, for example, tax debts. But just know that gross receipts taxes will follow the assets in an asset sale. So will certain other liabilities. I'm not sure if I included that on the slide, but let's talk about them in the context of this next slide. Creditors. A lot of people assume that selling or transferring the company's assets will put those assets outside the reach of creditors. But New Mexico, in addition to successor liability, which could put the buyer on the hook to the extent of the value of those assets, there's also what's called fraudulent conveyance statutes or fraudulent transfer statutes in most states that will let the courts overturn a transaction, a sale or transfer transaction, if the assets at issue aren't being sold for fair market value in an arm's length transaction. So, for example, I had a client who, not really a client, more of a lead. I didn't agree to represent them, but they wanted me to help them transfer the assets out of their company to a family member for $1 to keep them out of the reach of their creditors, because, an LLC in your hands is an asset to you that can be used or claimed by your creditors to satisfy their debts, your debts that they hold. And so they wanted to diminish the value of their LLC by transferring the LLC's assets to a family member. And I had to explain to them the fraudulent conveyance statute is pretty clear on that. I mean, it's a family member, it's not an arm's length transaction, and $1 is not fair market value for the assets. So it is a fraudulent transfer meant to defraud your creditors. The court will reverse that in a heartbeat. And so, obviously you don't want to find yourself in that position as the buyer where you could even come into that level of scrutiny. So you want to make sure that the seller This is where due diligence comes into play. Make sure they don't have any judgments against them. They're not in collections. Check their credit profile, the credit profile of them and their principals as part of due diligence. Make sure there's no outstanding debts and collections. Make sure there's no tax debts, etc. But also beware of deals that are too good to be true. If you have a seller looking to sell you all of their assets for pennies on the dollar, there's a problem there. That's not fair market value. So it's important to understand the motivations of the other party in a sale transaction. If they're selling for some legitimate reason, they want to retire, maybe they're in financial distress, fine. But if they're offering to sell you for pennies on the dollar as part of some scheme or another, where maybe they work into the agreement that they can buy the assets back at some point, for a premium on that, like they'll sell them to you for 10 cents on the dollar and then buy them back for 50 cents on the dollar and you profit, whatever the situation is, you could be running afoul of the fraudulent conveyances statutes. Another misconception is that there are ways for a seller to guarantee a positive outcome. And I tell my client each and every day, I guarantee nothing. It's the honest truth. You can't guarantee something. You can't guarantee that the seller is going to perform or the buyer is going to perform, and that someone isn't going to disappear into the wind or declare bankruptcy or do something that is going to either minimize the value of your investment or wipe it out altogether. A personal guarantee, for example, you can get all the personal guarantees you want, but if the guarantors declare bankruptcy, those guarantees put you in the position of any other unsecured creditor in the bankruptcy. Same with the company and security agreement. If the company wastes the assets, transfers them, sells them, or whatever, you're going to be in the position of having to try and claw them back with fraudulent conveyances statute. If they've been destroyed, they're lost. That's bad. You might be looking at insurance claims. You're going to be looking at selling or suing the buyer if you're the seller to try and recover something. I mean, the point I'm trying to make here is that there's no guarantee of a perfect outcome, no matter how well secured you are. So the best thing you can do for yourself is to make sure you're at least as well secured as you can be. That means making sure that the agreements are good. It means making sure that you have perfected your security interests, which is more than just getting down in writing that you have them. In order to perfect your security interests, you have to publicly record them in most cases, whether with the UCC financing statements we talked about, mortgages against the property, title liens with the Department of Motor Vehicles. You have to take extra steps to perfect your security interests, which is necessary to reserve your place in line, your seniority to those assets. Because if you don't perfect your security interests, and then the buyer, for example, takes on a bunch of other debt and gets creditors who do perfect their security interests, and then they go bankrupt, those other creditors could have priority rights to those assets over you, and you get nothing. So, you have to be diligent and you have to be thorough. And this is why hiring a lawyer is really useful, because you want to make sure that you're doing this right. It just protects your own investment. This is a big one for me personally. I am a transactional attorney. I don't litigate. I don't deal with lawsuits. We have another wing of our own law firm that does lawsuits. My job is to make transactions work for people. I have litigation experience, which is very helpful when, knowing how these deals can go awry. It helps to have some of that experience. It helps to start there as a lawyer, but transactional law and the whole practice of negotiating and consummating a transaction between a buyer and a seller, it is not a zero-sum game. It's not a situation where only one party can really win and one party is inherently going to lose. But attorneys who don't practice in business transactions and only practice in litigation will often approach it with a zero-sum mentality, where they try and, everything they do is meant to try and one-up the other party, thinking they can get away with it. The problem becomes if that other party has a lawyer, which I encourage everyone to have their own lawyer to represent their interests. It just makes things go better. If that other party has a lawyer, they're going to look at what's being proposed by the litigation attorney and say, no, we're not going to agree to this. You're clearly not serious about this sale transaction. We're going to walk away. I have had deals be scuttled by a well-meaning buyer or seller who made the mistake of hiring a litigation attorney to represent them in a sale transaction. I'm not knocking litigation attorneys. I'm not telling you how to live your life here and who to hire or not hire. I am suggesting that buying or selling a business is not a zero-sum game. It is a situation where both parties can get what they want and come out satisfied if done right. And so you want to get the right people involved. Doesn't matter if they're a family friend or family member or whatnot, if they don't handle transactions, I don't recommend using them. Get the right people involved, have a good transactional attorney. There are tons throughout the state of New Mexico who make this their practice and they're very good at what they do. And get a good accountant or CPA who can help you with the due diligence. Because I'll tell you, even as a tax attorney who primarily handles M&A transactions like these, I'm not an accountant. I don't really know how to do due diligence or scrutinize a financial statement that well. It's just not in my wheelhouse. So have a good team that can help make this whole thing go smoothly. I have a lot of clients who come to me who are at, the end of their rope. They want to get out, they have health issues, they want to retire. They're just not succeeding in the business. They don't have the money to put into it. They don't have the time, the energy, the expertise to scale it up. They just want out, but they don't know how because they don't have anyone on the line to buy their business. There are business brokers whose entire purpose, I mean, they're like real estate brokers, but they just handle the buying and selling of businesses. They will list businesses for sale by their clients. They will work with other brokers and would-be buyers and investors to find matches between buyers and sellers. It's an open market. So I would say if you're looking to sell, but you don't have a buyer and you don't know how, maybe look at a business broker. But here's a big but: business brokers aren't heavily regulated in this or most other states. So you want to do your research on a business broker before signing with them, because some business brokers are unscrupulous. They will take unreasonably high percentages relative to the industry standard. They might not be good at what they do. They might not have great listings or great relationships in the business community. There are business brokers who are so combative that they have burned bridges with every transactional attorney they've come across. I have dealt with brokers who I will never deal with again. So it's important to know who you're dealing with. And so if you find a business broker you like, great. Just make sure you do a little bit of research on them first, but that is an option for you. Utilize your resources. Like I said, build a good team who can help you through the process, but also the SBDC, the Small Business Development Center, is a great resource for you to lean on. They offer no-cost business counseling and loan application assistance, as I understand it, which means, if you're the seller of a business or a buyer and you just need a little help figuring out where to go, the SBDC is a great resource. Go to nmsbdc.org, look at what's available to you, and leverage your resources, because that's going to help you so much in this process. Where can a seller in New Mexico find a business broker? That is a great question. I cannot refer you to anyone specific here in this presentation, but what I can tell you is that you, even just with a Google search, can pull up a number of listings for business brokers. A number of them I personally work with from time to time. The internet, and I'll be blunt here, if they're worth the wait at all, if they're worth dealing with, they need to have a good website and they need to have a good web presence, because in the 21st century, that is one of the key ways business brokers are going to find businesses that want to be sold and people who want to buy a business as an investment. This is the 21st century and they need to have a good web presence. So I would recommend looking for some online and seeing what you find. You might also reach out to the SBDC and see if they have any good resources they can point you to. If nothing else, they can point you towards a business attorney maybe who has their own contacts in the community. The next question: how much do they usually charge? I've seen anywhere from 3 to 5% be standard. I've seen higher costs ranging up to 10%. I mean, it really depends on the specifics of what's being sold. If it is a high difficulty business with a lot of mechanics and legal issues that go into the sale process, the percentage will be higher. And I'll give you an example. I was working with a business broker and a client that was trying to sell, and they were very heavily regulated by the state. and the transition process to hand the business off to the buyer was extremely complicated. And so the business broker, in order to find a good buyer, they had to work harder and they charged a higher percentage. I think they charged 8%, which is high in my estimate, but that's kind of what the parties agreed on. It's really, at the end of the day, an agreement between you all.
And going into that question, also you said that with finding a business broker, that you get references. Was it references you were saying, or how would they go about researching it besides looking at their website?
You might see some reports on Better Business Bureau. A lot of business brokers are incorporated as LLCs or professional corporations. So you might look through the Better Business Bureau to see what you can dig up. If you Google the name, you might come up with other issues, Yelp, some review boards. I had one business broker come up on Reddit and they were torched on Reddit. So just look and see what you dig up on the web. Google reviews, a lot of them are listed on Google as Google businesses. And so you can see Google reviews for them, which is very helpful. And then you can actually go to nmcourts.gov. It is the website for all the state courts in the state of New Mexico. And you can search the court records for the name of the broker and for the name of their brokerage, if it's a company, and see if there are any lawsuits against them. That's also a good indicator when dealing with a business broker. If they have a bunch of lawsuits for fraud, for example, that might be an indicator. How much should a seller/buyer expect to budget for engaging a lawyer for the sale or purchase? It's a great question, and a lot of it, you can ask the lawyer for an estimate and they'll give you a rough estimate of what they think it's going to run. I will typically tell people the low end to budget is $2,500 each. $2,500 for the seller, $2,500 for the buyer, because each party should have their own lawyer to represent their interests. That goes up depending on the complexity. If we're talking a multifaceted seller finance deal where there needs to be a bunch of security instruments and perfected security interests and things like that, or due diligence is going to take a long time, the lawyer needs to be involved, or there's complex negotiations, that's going to go up. The highest I've ever charged a client for a business sale, and this isn't to spook you, but this is to give you an explanation of the scale of these things, was $60,000. That was a sale of a company for $7 million roundabouts to a buyer that has a net worth of about $6 billion. They're a huge multinational corporation. And so the legal fees ended up being $60,000 because the buyer had very strict requirements for the form of contract, for due diligence. Closing was such a moving target, it got moved back 8 times. So the costs can truly range depending on the complexity of the transaction. I say budget at a minimum $2,500. That is enough for, I want to say, the majority of my clients. If it's just a simple stock purchase agreement, bill of sale, promissory note, and a few other things, I can usually get it done for that, as can most other attorneys. I'm not plugging myself here. I'm just saying that's kind of the range. But yeah, talk to the attorney and see what they estimate for you, because every situation's different.